Hi, this is Randy Finney with the Right Side of the Chart, and today is Tuesday, March 13th, 2018. It is a little after 12:30 Eastern Time as I'm starting this video. I wanted to do just a brief update on the markets. For those of you who haven't followed or seen any of my recent market analysis, we'll just start out with the bigger picture real quick. And the bigger picture is this. This is a 10-year weekly chart, so these are weekly candles of the SPY, the S&P 500 tracking ETF. You had a primary uptrend line here that broke. We had a nearly 2-year sideways grind, or what is not very commonly referred to as a deer market. A deer market's a term for a sideways market that trends for an extended period of time. Bull markets obviously are uptrends, long prolonged uptrends, whereas bear markets are prolonged downtrends. So that's what happened, and that consolidation really set the stage for the most recent advance that we've had here. And again, most importantly, is this trend line. We have similar trend lines on the NASDAQ 100 as well, or a similar trend line, a long-term trend line. This one on the SPY comes off the early 2016 lows. And, as I've continued to maintain, even when we were testing that trend line that week, we'd have to have a solid weekly close, not an intra-week break below it. So being the fact that that was the first time during this recent correction from the January highs to February lows that we hit it, my expectation was for a reversal and a close back above that level for that level to hold, which it has. And you can see we've tested it for several weeks and we're above trend. So bigger picture, bottom line here, 401k money, long-term funds, long-term traders, trend traders, the trend is still clearly bullish with absolutely zero sell signals on the market. This was a correction so far. It may have longer term implications, here down the road. We may get another leg down, but these are the levels to watch, and I'll show you on QQQ as well. So that's that. So, bearishness ramps up just like bullishness was extremes here. Now everybody wanted to get bearish after the drop. They weren't bearish then. We were bearish and short on the site, net short, and bullish and net long here. So that's, you almost have to have this contrary mindset, but you can't be contrary for the sake of just being contrary. In other words, you can't short the market just when you think everybody else thinks it's going up, or go long when everyone else thinks it's going down. It's usually extremes, but most importantly, let the technicals be your guide. This is a trend line. If and when this trend line gives way, as well as the S&P 500, all the major indices, we start to see long-term trend indicators, intermediate-term trend indicators roll over first, then the long-term trend indicators. The evidence will build that this one of the longest bull markets in history just turned. If you back out that deer market period or the correction down here, technically the QQQ corrected about 26% during there. So, by definition, that was a bear market, but we didn't see that same drop in the NDX. QQQ is an ETF, so it had more of a flash crash. If you go back and just look at the NDX, you can see here, I've got so many boards. And I apologize for getting off topic, but I just want to show you that, the NDX was down close to it, right about, I think it missed the 20% mark by a hair, 19.96%. And again, we're splitting hairs, but what I'm referring to, guys, is in the general definition of a correction is a drop of 10% or more, whereas the general definition of a bear market is a drop of 20% or more. So, most wouldn't consider that a bear market. They would just, again, continue this continuation of the longer term trend. Plus, the S&P 500 never fell. The S&P 500 is really what I refer to as a broad market, a more diversified index. So there it is. Long term. Things are still, although we're certainly getting stretched here. Just now beyond 9 years into one of the longest bull markets in history. And by valuation metrics and everything else. So I continue to think the next bear. I look forward to it more than you guys probably believe. I embrace bear markets. I had a field day trading last bear market. Bear markets are, like bull markets in reverse, except in fact you hit the fast forward button. That drop from 2007, it was October, we peaked in 2007 in the markets and ended March 6th, the bear market. And that was a drop of 50 something percent. And, I was able to go long the counter trend rallies, short the rips, and go long on the dips down to support. And over that period of time, was able to do what I would normally make in a bull market over several years. I think we'll have an opportunity again. I don't think we'll see that waterfall sell-off type meltdown we had in 2008. I think it'll be a more prolonged bear market with trends, tradable trends, both rips, bear market rallies, and drops that are probably more conducive to the majority of people I'm talking to right now that aren't full-time professional traders or active traders. More swing traders where you can position for a lot of those rips I would trade would sometimes only last days. They would measure in double digits back in the previous bear market. And some would last a few weeks, but for the most part, I think the next bear market will just be a long, prolonged, downtrend with plenty of opportunities on the long and short side. So let's just wrap that up there. Enough on that. We'll speak more to the next bear market once it's underway. As of now, let's look at the 60-minute charts and just see where this market's headed in the near term. Okay, yesterday I told you that although for since the lows here, I've outlined a scenario of the market going on to make new highs. And when I say the market again, I was looking for all major stock indices to do it. So far, the Nasdaq 100 has done it. QQQ. This is a 60-minute chart. You can see here on a daily time frame, there's all new to all-time highs right there. But we go back to the 60-minute chart. This is the world I'm living in right now with increased volatility and really not having any sell signals on the daily time frame at this point. This is my go-to time frame for swing trading. With that being said, I always keep an eye on the longer-term charts, the dailies and the weekly charts. Not much to pay attention to on the monthly charts now because the long-term trend is so intact. The bullish indicators, trend indicators, everything else are still well intact. So there's not even a reason to visit the monthly chart yet, but there may be soon. Anyways, here we go. So yesterday I pointed out my concerns as the Qs had made, were at new highs, negative divergence, which is now confirmed. If we zoom all the way in here, you can see there's the bearish crossover on the PPO. I know sometimes it's hard for you guys on YouTube to make out the lines. Here, I'll make this one a little bit brighter. Let's do that. You can see that one a little bit better. Give it a bright color. There it is. Okay, so there's the bearish crossover now confirmed, which confirms negative divergence. So that's what the DH means. It's simple wash, rinse, repeat. Some divergent highs play out for larger corrections than others. There was one divergent high, there was another one, and that one, boom, big one. We had a divergent low there. It's played out for this entire rally so far, or we could say up to this point in time when we had a divergent high on the 60-minute chart. So you can see how one can there's nothing 100% in trading, but one can sit here and there's a divergent low right there led to that rally. In swing trade, these divergent highs and lows, trend line breaks and things like that. So as I always say, a divergent high in itself is not a sell signal, nor is a divergent low a buy signal. But when coupled with other things such as candlestick reversal patterns or trend line breaks, and that's where I'm segue into now. Yesterday, I highlighted these uptrend lines on QQQ right here with this divergent high. So now we do have that confirmed divergence on the PPO, not on the RSI. We made a slightly higher high, but close enough. There's a trend indicator I have divergence on. You don't have to have them on every indicator. And you can see as I zoom in, let's tighten that trend line up a little bit now. I think it needs to be tightened up there. There we go. So I capture all these candlesticks. You can see from the lows down on March, was that March 2nd? Yep. And now we're below that trend line. So we broke down on QQQ. And so far, this 60-minute candle is still below there. Let's see how we close the day. I can just tell you right now, I favor more downside at this point in the near term. I think we'll at the very least come back in to test those previous highs. When I say previous highs, again, as covered yesterday, QQQ recently broke out. We had that was the all-time high at that point. We had the correction. We came back, tested the previous highs, had a pullback, and then went up through here and we gapped up above those highs. So now that we've broken trend, maybe a little kickback rally, maybe not. I wouldn't try to game it. I think we at least come down and back test this 178.88-ish breakout level. And as I mentioned yesterday, from my experience, more often than not, when you come to back test to break out of new highs, just to not make it easy for everybody to load the boat on the back test, they usually take it down just below the highs. So maybe a gap backfill. And, this could certainly, let me just say this, could certainly morph into something much more. And I'm starting to lean that way right now. This is, if we just look at the charts, this is a nice, clean wedging type pattern with an uptrend, 60-minute chart, pretty powerful divergences. And this pattern would measure, take the measurement of a chart pattern or of a wedge. If it's a rising wedge, you take the widest part of the wedge and you add that to where the pattern broke down. So this could certainly take us down here. I highlighted this level in yesterday's video, 164.69, as a pretty important support level. There was a comparable level on SPY, which we'll get to in a second. So if I had to, and that's the beautiful thing about trading, you don't have to do this, but if I had to go long or short, if somebody put a gun to my head and said you have to short the Qs or go long right now, and walk away for a week, I would go short. I think we come back down here and test this, but again, we need a little bit more. Let's take a look and see what the SPY is doing, and at the very least, keep things light. I wouldn't go extremely aggressively short right now, but that is the scenario which I've rapidly been leaning towards because again, QQQ as the leading index made new highs, although SPY didn't. And I'm going to talk on that well, let's just get to SPY and I'll tell you what I'm thinking here. All right, so here's SPY. Now, this is why you have to wait. And this is why I said let's take a look at the chart. SPY so far, let's clean up that trend line. When we zoom in, I'm tightening it up. What I'm trying to do is capture as many reactions as possible. Trend line drawing is more of an art than a science, in my opinion. There we go. We have a lot of candlesticks there. We have a couple wicks. That's fine as long as these 60-minute closes. In other words, the candlestick body is above there. What I try to do when drawing trend lines is capture the most number of reactions, whether it's a body or a candlestick shadow or wick, they call it down. I'm sorry, a tail on the bottom. Wicks are when the shadow is above. That's the skinny part. So there it is. Nice, clean, pretty clean trend line. A lot of reactions. So far, we bounced off that trend line today. What does that mean? Well, QQQ appears to have broken down, but the SPY hasn't. And one thing I always say, whether you're trading the broad markets or individual stocks and you're waiting for a sell signal in the broad markets, in my opinion, one of the worst things you can do is short a breakdown of any one index that you're watching without keeping all the major indices on track. Now, really, I focus mainly on SPY and QQQ. You can add the Dow in there if you want. You can add the small and mid caps, but again, small and mid caps don't have nearly the significance in the stock market as do the large cap indexes. They make up a small fraction of the total value of the stock market, and ultimately they're going to follow the large caps here. So this is the big one, and like I said, you want to really increase the odds of a buy or sell signal on the markets. You wait for both the SPY and QQQ to break out or break down on whatever time frame you're looking at. So that's the story right now. SPY has tested support, but so far it held it. We do have confirmed negative divergence. You can see the crossover there, the bearish crossover. That's lower than this peak back here. So there's the divergence line drawn out. The divergence started all the way back here when we hit our second price target on the SPY trade. We had the divergent high right here. That led to a pretty good correction on the 60-minute time frame here. And then we pushed up. So again, this is really what I refer to as just an extension of the previous divergent high, because these are consecutive divergences. Or again, you can draw it out this way. Made a slightly higher high on the RSI again, but about equal highs on my 1333 EMA trend indicator. And that's it. This is a level to watch. You want to see a very impulsive break and or a 60-minute close below that level. I went over that potential target on QQQ a minute ago, and this is a level I covered yesterday on SPY as well, what I refer to as a comparable level. We had quite a few reactions back here, reactions here. We had a reaction right there, and that level is 2690. So before we get there, of course, well, number one, we have to take out the trend line. Then we have this gap. Naturally the top of the gap as well as the bottom of the gap acts as support when tested from above. Most gaps, not all, but most are usually backfilled at some point. So therefore, even if we get a reaction off the top, if this trend line goes, I favor at least a backfill of that gap. And again, I'd say there's a pretty decent chance at this point in the coming weeks that we may go on to hit that 69.90 level, even if we are going to make new highs on the SPY like I talked about. I'm still not ruling those out by any means. In fact, I think there's a good chance we'll do that this year, but again, I always say chart, forecasting using the charts is a lot like weather forecasting. The weatherman can tell you with a high degree of accuracy if it's going to rain this afternoon, or what the weather's going to be like, temperature and all that. But going out a week, 2 weeks, 3 months, um, it's the accuracy of any forecast is greatly diminished. So that's the same with charting, and that's why I always say the charts are dynamic, and so it was my analysis. So this is it right now. Things not looking good, but we don't have really confirmed sell signals on the broad market yet. Close. So let's just watch that. Those are the levels. Oh yeah, the other thing I wanted to talk about real quick from a technical perspective, more really to do with market breadth, is initially I was impressed on the rally QQQ. As I talked about, QQQ was much stronger off the lows after the correction than was SPY. You can see here, and again, the futures were, even had lower lows. When you look at the NQE minis futures, we had even a bigger drop. But just looking at QQQ during the, regular session trades, you had a gain of about 16.5% off the lows, roughly. I'm just using the measuring tool in the pop-up box to the right. And we went to new highs, as you can see there. So almost a 17% gain, and that compares to SPY with only a gain of about 10.5%, and still well off the highs. Now, what that tells me is um, a lot like, for example, the market top back in 2007. I saw this, and a lot of even some of the before the big corrections that we've had in this market in the last 9 years. Um, this shows me a lack of market breadth, meaning the S&P 500 is a much more diversified index than the Nasdaq 100. The Nasdaq 100 is very tech heavy, doesn't hold financial stocks, it's lacking certain sectors, and it has the beloved, what I refer to as FANG stocks, FAAMG, Facebook, Amazon, Apple, Microsoft, and Alphabet, which is symbol GOOG. Hence the G. So those are the beloved stocks. Everybody gobbled them back up. Everybody that wanted to own them for the last few years, once they saw how well they were doing and just never had a good opportunity to buy them, stepped in and bought them. And at first, that on face value, that was bullish. But this shows me, more I look at this as a lack of participation in a lot of other sectors. Now, I will say this, there are a lot of interest rate sensitive stocks in the S&P 500. In fact, if you want, yield, you go to the S&P 500. It has your, Procter and Gamble's of the world, dividend paying stocks. It has utilities and things like that, stocks of that nature, financials, which again, the Nasdaq 100 doesn't have any financial stocks within it. And those are dividend paying stocks. So as such, we've also seen a tick up in rates. So things aren't as clear cut as they have been in recent years. You have to factor some of that in. And that's why at this point I'm trying to tell you, I just, you know, intermediate term, looking out a few months, whether this market's going on to make new highs and going a lot higher, I still lean towards that scenario, but I can't say it with absolute conviction. So all we can do right now as swing traders is watch these short term, these 60-minute charts, watch these levels. Um, if the market can ramp up, if the SPY can hold on to this trend line, or maybe a false breakdown, a little quick breakdown, bounce off support, come and back test that trend line at a higher level. If it does so, if we move up much higher, we're going to take out these negative divergences on the PPO. So like I said yesterday, we're just barely clinging to these negative divergences, and there's a possibility they get burned through. So that's why we closed out. We hit my final target on the SPY trade that we bought back down here on this pullback right after the lows. And that official trade, it's out. We're flat now. We'll just sit back and watch. I'm not ready to short, especially SPY yet. QQQ might look like an attractive shorting up here soon, especially if this level goes on SPY and that breakdown on QQQ holds. All right, we'll wrap the video up real quick with IWM small caps. There it is, similar trend line. I told you yesterday this trend line's not very well defined. We did break below it. By well defined, we only have two reactions until today. Wasn't really much of a reaction. We moved through it, but we did have negative divergence, which is confirmed. And that failure came right around the previous reaction highs as well. So, so far this has just been a kickback rally. Will the small caps go to new highs? If this S&P 500 does, most likely they will. But we have to just wait and see what happens here. We're at a pretty critical technical juncture in the markets near term. Here's MDY. It has not broken trend. So again, this comes back to what I was saying before. You want to watch, and if you want to give yourself the benefit of the doubt and not jump the gun on shorting the market if that's what you're looking to do, or if you're looking to stay long right now and not get shaken out of this rally, then you want to see all of these trend lines break. You want to see the mid caps break trend on the 60-minute chart. You want to see the S&P 500, the QQQ, etc. And that will greatly increase your odds of a false breakdown, because if they continue to move lower from here, they break these trend lines, these divergences will be even more so confirmed, and lower chance that'll be a whipsaw signal. But again, there's quite a bit of support along the way. At this point in time, I will just make it clear, I do not think we're going to take out these lows. I already gave you my what I think are, at least within, a fair amount of probability what I think are the worst case scenario, and that's a move down to these levels here. Again, these are all comparable levels that I just showed you on SPY, QQQ as well. These were the lows that were tested around mid-February, and that would be where I think the markets hold. Where I think if we get there, that would offer the next objective long entry for the next rally up. So maybe there's a shorting op down there with a position long for a move up to new highs. But if these levels go with conviction, again, put higher weighting on the S&P 500. There's that level. I'll make that line a different color just to let it stand out here. 269.90. If we start to see those levels go, things could get ugly, and I think the selling would accelerate, and you'd probably have a waterfall sell-off and probably come down, either test or maybe undercut those lows. Who knows? We'll take it from there if it happens. So right now, like I said, near-term bias. If I have to give you what's going to happen today, tomorrow, next week, I think this trend line is going to go, and I think we're going to come back down here and here and here until it does. Why short right here? On the SP on the SPY, when that trend line is a mere, a 1/4% below. It's only prudent to wait for a little bit more downside. Wait for either an impulsive move down below that trend line and or 60-minute close, and then you could take a short position, put a stop not too far above wherever you want. If you're targeting that 269.90 level, that would be a drop of about 2.5, 2.6%. So you could, take it with a stop of about, a little under 1%, somewhere up there, probably above the recent highs. That would give you about a 3-to-1 risk reward ratio. Allow for a little kickback rally to backtest the trend line, but we really shouldn't go much above those previous highs. So that, and again, if I were to short one or the other, I would short QQQ over SPY right now. I could tell you that, or even the mid caps if you want, probably, or small caps, I should say. You get more juice shorting the Qs or the small caps if there is a correction in the market. All right, we'll leave it there. This has been Randy Finney with Right Side of the Chart. As always, if you enjoyed the video, please give it a thumbs up on YouTube. And if you're a member of the site, I have several trade ideas. I put a new trade idea out there today on Netflix. I have several more in the queue ready to go. And I plan to, over this week, probably increase the official trade ideas by a pretty fair amount. Okay, have a great day, guys.